Investing during uncertain times can be challenging, but there are strategies to keep in mind that can help navigate the volatility. To give us insight on the topic, we're joined by the Divisional Director at jpmorgan Wealth Management, Mike Ayerov. Welcome.
Thanks for having me.
Can you first talk a little bit about what's causing the volatility we're seeing in the markets?
Yeah, of course. So, despite so much happening in the US and across the world, from a social and a geopolitical perspective, the current volatility is primarily driven by the uncertainty around tariffs and the concerns around inflation. And that uncertainty can make things difficult for investors. But if we look at the world from a longer time view, we're reminded that we faced a ton of challenges as investors in the past, whether that's been wars or natural disasters, a global financial crisis, or even a global pandemic more recently. We remember that markets tend to be resilient over time.
With that in mind, what should investors focus on to help combat the volatility?
Everyone's financial situation is unique. It's important to stay focused and ensure that we're investing with intention, because it can be easy to get caught up with all of the headlines and feel like we should be doing something in response to this volatility. But making an impulsive decision may not be the best thing to do, because timing the markets can be difficult, especially given that so many of the best days tend to occur in close proximity to some of the worst days in the market. And missing just a few great days in the market can have a significant impact on your performance over time. Let's look at an example from our asset management colleagues to bring that to life. If you stayed fully invested in the S&P 500 from December 2004 through December 2024, so that's 20 years, you would have seen an average return of about 10%. But if you missed just the best 20 days over the course of 20 years, your return would have been reduced to a little over 3%. And that is why it's so important to stay invested and focus on the long term, even as markets fluctuate.
And going off of that, what advice do you have for investors who may have seen a dip in their investments in terms of how to react?
Yeah, I would say the most important thing to do right now is to have a plan if you don't already have one, or revisit your existing plan. And Chase customers can create a plan for free on the Chase app or on chase.com using Wealth Plan. Wealth Plan is a tool that provides a holistic view of a client's finances, real-time tracking, and step-by-step guidance and advice from our advisors. And alongside your advisor, you should revisit your plan on a regular basis. And a market downturn can create a great opportunity to rethink your goals, your time horizon, and how much risk you're really comfortable taking. Because we help clients invest for life goals, not short-term market movements. And times like these really reinforce the importance of having a solid plan.
And where can people turn to for guidance?
So if you work with a financial advisor, I encourage you to lean on them for their advice and their perspective on your investment decisions. JP Morgan Wealth Management has financial advisors in Chase branches across the country, and over 200 years of navigating challenging markets alongside a depth of intellectual capital and thought leadership to help clients navigate these times. Sound advice matters more than ever during periods of market volatility. And if you're working with an advisor, make sure you're working with an advisor that you're comfortable with. Or if you're investing on your own, make sure to be seeking trusted educational resources. One great place to start is our online educational hub at chase.com/theknow. It's resources like these that can help give you more confidence.
A lot of great insight there. Thank you so much for being here today.
It was great. Thank you so much for having me.